Have you ever wondered if cash, as we know it, will become obsolete in the near future? With the rise of digital currencies and central bank-backed digital currencies, CBDCs, the financial landscape is shifting dramatically. In fact, the future of money could look completely different from what we're accustomed to. But what does this mean for you, your wallet, and your everyday financial decisions? In this video, we're diving deep into the evolution of money, how digital currencies are reshaping the future of finance, and the implications for consumers like you. Let's explore how this technology could change everything, from how we spend to how we save, and even how central banks control the economy. Understanding the evolution of money. Money has come a long way from the days of bartering. From the first coins in ancient Lydia to paper notes in the Middle Ages, and now to digital currencies, we have continuously adapted how we exchange value. The question now is, what's next? Historically, money served three basic purposes: a store of value, a medium of exchange, and a unit of account. Over time, this simple concept has evolved alongside technological advancements. Today, we live in an age where digital payments are a norm, and even cryptocurrencies like Bitcoin are challenging traditional financial systems. However, digital currencies and the rise of CBDCs bring us to a new frontier. These innovations aren't just tweaks to the system. They could redefine the very concept of money itself. What are digital currencies? At its core, a digital currency is simply a form of money that exists purely in digital form. It has no physical counterpart, like paper bills or coins, and relies on digital systems to store and transfer value. In today's world, digital currencies are mostly used in the form of cryptocurrencies like Bitcoin and Ethereum, but their potential goes far beyond this. What sets digital currencies apart from traditional money is the way they are managed. Instead of being controlled by central authorities like governments or banks, cryptocurrencies use decentralized networks, typically based on blockchain technology, to keep track of transactions. This decentralization is what makes cryptocurrencies so revolutionary. For example, Bitcoin, the first and most well-known cryptocurrency, was created in 2009 by an anonymous person or group known as Satoshi Nakamoto. Unlike traditional currencies, Bitcoin doesn't rely on a central bank for its creation or management. Instead, it's mined through a complex computational process that ensures a fixed supply and a secure, transparent record of transactions. The rise of central bank digital currencies, CBDCs. While cryptocurrencies operate outside of traditional financial systems, the world's governments and central banks have been taking a different approach to digital currencies. They are exploring the concept of central bank digital currencies, CBDCs, which are essentially digital versions of national currencies, controlled and issued by central banks. CBDCs aim to combine the benefits of digital currencies, like fast and secure transactions, with the stability of traditional money. Unlike Bitcoin or Ethereum, which are decentralized and not tied to any government or financial institution, CBDCs would be fully regulated by central banks, ensuring their value remains stable and reliable. Countries around the world are already experimenting with CBDCs. China, for instance, has been leading the charge with its digital yuan, also known as the ECNY. In 2020 and 2021, the Chinese government began testing this digital currency in several cities, gradually expanding its use. The goal is to make transactions faster, cheaper, and more secure, while also allowing the government to have greater control over monetary policy. But it's not just China. The European Central Bank is exploring the possibility of the digital euro, while the Bank of England has also stated that it is considering the development of a digital pound. These countries are looking to offer citizens a secure and government-backed alternative to private cryptocurrencies. How digital currencies and CBDCs will change consumer finance. The rise of digital currencies and CBDCs will have profound implications for consumer finance. Let's take a look at some of the key ways these innovations are likely to impact your everyday financial life. Faster, cheaper transactions. One of the most immediate benefits of digital currencies is the speed and cost-effectiveness of transactions. In a world where we are increasingly relying on digital payments, the ability to send money across the world in seconds without high fees is a game changer. For example, traditional cross-border money transfers can take several days and often come with significant fees. However, digital currencies like Bitcoin or CBDCs could reduce these transfer times to mere seconds and significantly lower the associated costs. This would make sending money abroad, paying for services, or even buying goods from overseas much easier and cheaper. Financial inclusion for the unbanked. Another exciting possibility is financial inclusion. According to the World Bank, around 1 billion people worldwide are unbanked, meaning they lack access to basic financial services like savings accounts, credit, or loans. Digital currencies and CBDCs could provide a solution to this problem by offering low-cost, accessible financial services to those who have been excluded from traditional banking systems. For example, someone living in a rural area without access to a physical bank could use a smartphone or a digital wallet to send and receive money, pay bills, and even apply for loans. This could open up new economic opportunities for millions of people who were previously cut off from the global financial system. Enhanced security and transparency. With digital currencies and CBDCs, transactions could become far more secure and transparent. Blockchain technology, which underpins most cryptocurrencies, creates an immutable, transparent ledger of every transaction. This means that all transactions are publicly recorded, providing accountability and reducing the potential for fraud or corruption. Additionally, because digital currencies operate on secure networks, the risk of hacking or identity theft could be significantly lower compared to traditional banking systems. This enhanced security could help build trust in digital currencies, making them more appealing to consumers and businesses alike. The shift in consumer behavior. Digital currencies are likely to change the way consumers approach spending and saving money. The use of CBDCs could make transactions more instantaneous, meaning people may start to spend more frequently and in smaller amounts. This shift in consumer behavior could have a profound effect on the global economy, as it could spur faster economic activity. On the other hand, digital currencies could also encourage more saving and investment. With the rise of digital wallets and the ability to invest in cryptocurrencies, consumers could find it easier to build wealth outside of traditional banking systems. This shift could lead to a greater focus on personal finance and investment planning as consumers become more empowered to manage their own money. The future of money is digital. With the rise of digital currencies and central bank-backed digital currencies, we are on the cusp of a financial revolution that could reshape everything, from how we spend and save to how governments manage economies. As consumers, it's important to stay informed and understand how these changes will impact us. The key to thriving in this new era of finance is knowledge. Stay curious, stay aware, and keep adapting. If you found this video helpful, don't forget to like, subscribe, and leave a comment. Let's continue exploring the future of money together.